Imagine waking up one day and realizing that your dividends cover your rent, your groceries, your vacations, and your job has quietly become optional. That isn't luck. That's the life cycle of a dividend investor done right, decade by decade. The way you invest for dividends in your 20s should look very different from what you do in your 50s. Each decade has a specific mission: build, accelerate, defend, and harvest. If you try to live off dividends too early, you'll starve your future. If you chase high yield too late, you'll risk blowing up the safety you spent years building. So let's walk through your 20s, 30s, 40s, and 50s as one continuous story. The evolution of a dividend investor from broke beginner to income machine. You're in your 20s. You don't have much money, but you have the one asset older investors would kill to buy from you: time. This is the decade where every small dividend reinvested has decades to snowball. So your main job is not to get income now, but to plant seeds in the right soil. Here's the mindset shift. In your 20s, dividend investing is not about collecting cash. It's about building a compounding engine. That means focusing less on giant starting yields and more on quality businesses or ETFs that grow their dividends every single year. Think of companies and funds that might only yield 2 to 3% today, but have a history of raising payouts at high single or double-digit rates. This is where dividend growth beats fat yield over long stretches. A high-yield stock paying 6% but never growing its dividend looks attractive in year one, but a 2 to 3% yield that grows quickly can surpass that income within a decade and then keep pulling away. Reinvest those growing dividends, and you are quietly turning every share into a tiny worker that keeps hiring more workers for you. So what does a 2070 strategy look like in practice? You're heavy on equities, often 80 to 90% or more, because your long horizon lets you ride out volatility. You lean into diversified dividend growth ETFs or broad index funds plus a few quality dividend payers, rather than stock picking every position. You automate contributions, reinvest every rupee or dollar of dividends, and ruthlessly ignore the urge to cash out that free money for short-term wants. For your 20s, the biggest dividend decision is not which stock you pick, it's whether you actually start. A 5-year delay at this age can cost you more income in your 50s than every hot pick you ever chase. Then your 30s arrive and life gets real. Career pressure, maybe marriage, maybe kids, home loans, responsibilities. But here's the twist. Financially, your 30s can be the most powerful decade in your entire dividend journey. You often earn more, yet still have 25 to 30 years before traditional retirement age, which is an incredible runway for compounding. The mission of your 30s is to turn small compounding engine into a serious wealth machine. You're no longer just getting started, you're scaling. That usually means you still prioritize dividend growth and total return, but you begin to introduce a little more balance, a slightly higher starting yield here, a bit more stability there. This is where simple asset allocation rules of thumb show up. A typical framework might suggest something like 70% to 80% in equities and the rest in bonds or safer assets, adjusting for your risk tolerance and how stable your income is. Within that equity bucket, you might blend broad index ETFs, dividend growth funds, and a core of reliable dividend payers with track records of increasing payouts for many years. Your secret weapon in your 30s is consistency plus pay raises. Every time your salary jumps, you increase your investing contribution instead of your lifestyle. Automatic dividend reinvestment remains your default because you still don't need the cash. What you need is bigger future income. If markets drop, you remind yourself that lower prices plus reinvested dividends are literally accelerating the number of shares you own. A big trap in this decade is yield envy. You'll see older investors living on 5 to 6% portfolios and feel tempted to copy them right now. But you and they are playing different games. Your superpower is time, theirs is capital. You can afford a lower current yield if it buys you higher growth and total return. For your 30s, treat every dividend as a vote for your 50-year-old self. If that future version of you could speak, they wouldn't say, thanks for that 6% yield you spent in your 30s, they'd say, thank you for reinvesting aggressively when you had energy and years on your side. By your 40s, something strange happens. Many people feel late to investing, but from a dividend perspective, 40 is not old at all. You still have roughly 20 to 25 years until traditional retirement age. In other words, there is still plenty of time for dividend growth to work, as long as you stop procrastinating. The 40s are the decade of transition, from pure growth mode towards a more balanced, resilience-focused portfolio. Your focus starts to shift from how big can I make this to how reliable and sustainable is this income going to be. You're thinking about children's education, maybe aging parents, maybe your own health and career longevity. Asset allocation-wise, it's common to still have a large equity portion. Many investors in their 40s reasonably keep a significant chunk in stocks depending on their situation. But within the stock bucket, your mix evolves. You might move slightly away from ultra-aggressive growth names toward more established dividend payers, dividend ETFs, and even some value-oriented sectors like consumer staples, utilities, or healthcare that historically pay steady dividends. Dividend-wise, you're walking a tightrope. You want a portfolio that yields more than in your 20s and early 30s, maybe edging up into the 3 to 4% range overall, but you still want room for dividend growth. Chasing ultra-high yield here can backfire, locking you into fragile businesses or funds that might cut payouts right when you're depending on them most. Another big lever in your 40s is risk management. You cannot afford as many big mistakes as you could in your 20s. Concentrated bets, speculative lottery ticket high-yield plays, and heavy leverage become far more dangerous. Instead, diversification across sectors, geographies, and a mix of individual dividend stocks plus ETFs becomes more attractive. A useful mental reframe in your 40s. Dividends are now not just a growth tool, they're your rehearsal. You can start experimenting with what living off part of your dividends feels like. Maybe you take a small slice of your income stream and use it for one category, like paying a specific bill while still reinvesting the rest. That experience will be invaluable later. For your 40s, this is the last decade where a decisive course correction can still dramatically change your retirement outcome. 10 years of focused, higher savings rate plus a solid dividend strategy in your 40s can do more for your 60s than 20 years of half-hearted investing in your 20s. Then come your 50s, and this is where the dividend story really gets interesting. For many, this is the decade where dividends in theory become dividends paying real bills. You're either closing in on retirement or already thinking about downshifting, and you want your portfolio to move smoothly from growth engine to cash flow machine. The mission of your 50s is to harden the system. You're now prioritizing 3 things: stability of income, preservation of capital, and protection against inflation. That means nudging your portfolio further towards reliable dividend payers, fixed income, and other lower volatility assets, while still keeping enough equity exposure so your income can grow over what might be a 30-year retirement. A common guideline is that by the decade leading into retirement, many investors will have a more balanced mix between stocks and bonds or equivalents depending on their risk tolerance and total net worth. Within the stock sleeve, your holdings often tilt towards sectors known for steady dividends, utilities, consumer staples, healthcare, certain financials, and real estate investment trusts, plus broad dividend ETFs that diversify company-specific risks. At this stage, your overall portfolio yield might sit somewhere in a moderate but meaningful range, depending on how aggressively you've built it. The key idea from many seasoned dividend investors: you don't need the highest yield, you need the most dependable yield that can at least keep pace with inflation and survive tough markets. This is also where sequence of returns risk appears. If markets crash in the first years of you drawing income and you're forced to sell shares at low prices, your portfolio can be permanently damaged. A dividend-focused strategy helps by giving you income that doesn't require selling as many shares, But you still need safeguards, some cash buffer, some bonds, maybe a ladder of safer fixed income instruments depending on your situation. Your relationship with reinvestment changes too. Instead of automatically reinvesting every single dividend, you may now deliberately start taking a portion in cash to support living expenses. Many investors ease into this, first turning off reinvestment for a few holdings, then progressively for more until they've aligned their dividend income with their monthly budget. For your 50s, this is where you find out whether your past self treated you kindly. If you built a strong base in earlier decades, your dividends now feel like a safety net. If you didn't, the temptation to take wild risk to catch up becomes dangerous, and resisting that temptation may be the smartest move you ever make. Across all these decades, a few principles quietly connect the entire life cycle. First, asset allocation matters as much as stock selection. Simple age-based frameworks, starting heavier in equities when you're younger and gradually shifting towards more income and safety later, exist because they align with changing risk capacity over time. The exact percentages are personal, but the direction of travel, from growth-heavy to income-aware, is consistent across most serious strategies. Open your broker app, pick one simple dividend vehicle that fits your stage, and automate just one monthly contribution today. Then commit to increasing that amount every year your income rises. The sooner you align your behavior with your decade's mission, the sooner your future self wakes up in a world where dividends don't just show up as numbers on a screen. They show up as time, freedom, and choices that your salary alone could never buy. If you found this breakdown of the dividend investor's life cycle helpful and it gave you clarity about what to do in your current decade, make sure you hit that like button so this video reaches more future dividend millionaires.